Good evening, everybody. My name is Fraser, and this is Rayhan, Curtis, Nathan, and Brian. We are from the University of Alberta, and we are here to initiate coverage on secure energy services with the hold recommendation and a $19.25 price target. Secure is a good company financially and fundamentally. It has a proven management team who has demonstrated the ability to grow profitably and to capitalize on industry trends. However, at the current time, our valuation and analysis show that a lot of the upside associated with this growth is currently being priced into the stock, and so we recommend that investors wait for a more attractive entry point at this time. Secure operates 3 divisions, the first of which I'll touch on is the drilling services division. So as Secure's customers drill increasingly complex oil and natural gas wells, they are required to inject any number of drilling fluids into these wells. These do everything from contain well pressure to prevent well blowouts, strengthen the geological formation, and increase production rates, and more. The list goes on. So Secure sells these proprietary drilling solutions to its clients. The next division is the processing, recovery, and disposal division. So when an oil and gas well is producing, or when an exploratory well is being drilled into the ground, a whole bunch of fluid and solid byproducts come out. And so Secure takes this fluid and solid waste to one of its terminals, where it will treat the emulsion and get rid of it in accordance with environmental regulation. Additionally, they will get crude oil ready for pipeline and rail specifications. The third division is the on-site division. As the name suggests, this takes place entirely back on the well site. What Secure does here is provide environmental consulting, construction, and well reclamation services. So what this means is that over the entire life cycle of the well, Secure isn't completely engaged with the oil and natural gas producer, which is something that not many of its competitors can offer. Secure operates facilities across the Western Canadian sedimentary basin and the Bakken in North Dakota. As you can see from this map, we see a great opportunity for Secure to leverage its existing infrastructure to crude by rail, as well as liquefied natural gas export opportunities in the near future. Additionally, we see Secure's management growing this facility footprint by 5 facilities per year. This is in accordance with its Vision 47 mandate. I'm now going to pass this off to Brian, who's going to walk you through some of the industry fundamentals that we factored into our valuation.
So as Fraser mentioned, Secure is uniquely integrated into the operations of oil and gas producers. Secure can offer crude by rail loading terminals, pipeline terminaling, and over 40 patented drilling fluid systems. Secure also operates a zero-margin crude purchase and resale business, which it purchases crude from producers at the wellhead and delivers it to market. Currently, producers still hold 49% of the share for the waste disposal market, which Secure has strategically aligned itself to capture. As it stands, producers are faced with the decision of directing capital expenditures to driving their drilling program or constructing their own waste disposal infrastructure. By outsourcing these waste disposal services to companies such as Secure, producers can use capital to drill new wells and drive their own shareholder value. Our analysis shows that within the next 5 years, first-party producer market share will decline by 15%, allowing Secure to capitalize and capture a total of 5%. The fluids disposal market is largely driven by the current production of oil and gas, but oil and gas wells are not created equal when it comes to water production. An oil well tends to generate up to 8.5 times the amount of water than that of a gas well. With the oil to gas well ratio increasing in the last 5 years, combined with the fact that aging wells produce increasingly larger amounts of water, we see significant growth potential in this area of the market. Horizontal drilling has quickly grown to account for the majority of new wells drilled in the Western Canadian sedimentary basin. With the increased complexity of these wells comes more meters drilled per well and more operating days required to complete these wells. This drives services providers' sales growth by requiring more drilling fluids downhole and equipment to stay on-site longer. I'm now going to pass it off to Curtis, who's going to dive into our financial analysis.
Thank you, Brian. Secure has experienced rapid top-line growth with revenue up tenfold over the last 4 years. However, this has been accompanied with a fall in profitability margins, suggesting either increased costs to fund such rapid expansion or the entry into the lower margin drilling services business through the acquisition of Marquee Alliance in 2011. You can see that there's a wide spread between the EBITDA and the EBIT margins. This is due to the large depreciation and amortization expenses associated with funding such rapid facility growth. This is also magnified by the 18th month lead lag time between capital expenditures and cash flow, which is a result of the 18th month ramp-up period for each facility. Moving forward, we want to use our forecast to analyze Secure's sources and uses of cash flow. So on the left-hand side, we have Secure's sources, which come from external financing, or debt and equity, and internally generated cash flow, or cash from operations. On the right-hand side, we have Secure's uses of cash flow, which come in the form of dividends, capital expenditures, as well as acquisitions. So in 2014, we estimate that Secure will need to raise both debt and equity to fund its acquisitions, as well as the remainder of its capital expenditures. In 2015, however, we see a much different story play out. We see that internally generated cash, or cash from operations, is more than enough to finance its capital expenditures, its dividend, as well as generate a funding surplus. Now, it's important to note that we've modeled in a doubling of the dividend in Q2 2015 as 3 facilities come online, which can generate more cash flow, which can be payable to shareholders. Moving from 2016 through 2018, we see much the same story play out. We see internally generated cash flow is more than enough to fund its capital expenditures, its dividend, as well as generate even larger funding surpluses. Now, these funding surpluses are very important because it provides Secure with the flexibility to either increase its dividend further, buy back shares, pay down debt, or complete accretive ad hoc acquisitions which will complement Secure's existing business line. Of course, this growth could all be accelerated should Secure decide to tap its $220 million in excess balance sheet capacity and unlock shareholder value by pursuing levered growth. I'd now like to pass it off to Rehan to discuss valuation.
Thanks, Curtis. So now I'll give you a high-level overview of some of our key valuation assumptions. So one of the major components is revenue, and we forecasted each business segment separately. So the first one is the Processing, Recovery, and Disposal division, which has 2 key drivers. The first is the number of operational facilities, and the second is crude oil production. So we see the number of operational facilities increasing by 5 per year in line with management guidance, and we see crude oil production increasing by about 4.25% per year over the forecast period. For the second division, or drilling services, there are a few key drivers, one of which is the number of active rigs, as well as the drilling activity in the Western Canadian Sedimentary Basin and Secure's market share in North Dakota. For the last division, or on-site, given that it is still quite young and shares similar drivers to the drilling services division, we forecasted on-site as a percent of drilling services revenue over the forecast period. So that kind of summarizes our segmented revenue. Next is capital expenditures, and we forecasted that in line with historical figures, and it's largely driven by that increase in facilities we talked about earlier. We also depreciated the assets on a straight-line basis in line with the company's current accounting practice. We used a terminal growth rate of 2.4%, which is in line with Canadian economic activity, as well as an average WACC of 8.1% over the forecast period. So, using these key assumptions, as well as our other assumptions, we arrived at a target price of $19.25, implying 6.1% of upside, including the dividend yield. However, just to double check our DCF price, we also conducted a comparable companies analysis. So we used a peer group EV/EBITDA multiple of 9 times and applied a historical premium of about 43%, giving us a total multiple of 12.9 times, and that implied a share price of $19.34. So as you can see, it's quite close to that DCF price of $19.25. So it confirms our target. However, since there's only about 6% of upside, we see Secure as a hold instead of a buy. I'd now like to pass it off to Nathan to talk about some of the risks.
Thanks, Rehan. So we do not view Secure as an overly risky company in comparison to its peers in the energy services subsector. We've identified Secure's most probable and least severe risk as the skilled labor shortage in Alberta. This labor shortage is forecast to persist over the next decade. Regulatory risk refers to Secure's most recent expansion into North Dakota, which will involve operation under new regulatory jurisdiction. According to Secure's management, regulations in the Bakken, or the North Dakota, is 15 to 20 years behind that of Western Canada. The oil and gas field service industry is largely influenced by exploration and production companies, as well as their drilling activities. While we don't see production in the Western Canadian Sedimentary Basin or the Bakken slowing down anytime soon, downward pressure in oil and natural gas prices, as well as faster decline rates in unconventional oil plays, could discourage producers from expanding. We want to note that Secure is less exposed to price fluctuations than producers, as well as their competitors. Finally, a lawsuit that's currently on the table against Secure poses the most firm-specific risk. However, we find this lawsuit to be very improbable of materializing over our forecast horizon.
Our investment thesis on Secure can be summarized as follows. It's a good company and it's backed by strong management. We've seen them grow from, I think, 23 facilities back in 2009 to a company who is well positioned to capitalize on some of the industry trends we see prevalent today. And over our forecast period,